Good morning, everybody. It's Wednesday, December 11th, 5:24 a.m. Central Time. Grain markets are mixed to higher this morning. March corn futures up 0.75 cents at 449 3/4. January soybeans down 3 1/4 at 991 1/2. March Chicago wheat up 1 3/4 at 563 1/2. March Kansas City wheat up 1 1/4 at 567. March spring wheat is up 0.5 cent at 607. We had a USDA report yesterday. Why don't we start there?
We sure did. Corn futures rallied following the report. The nearby March 25 contract gained more than 7 cents per bushel to close at $4.49, its best close since early October. USDA increased its projection for current marketing year U.S. corn exports by a whopping 150 million bushels amid a strong sales pace. The projection for corn demand via ethanol was increased by 50 million bushels. The end result was a 200 million bushel reduction to the 24-25 U.S. carryout projection.
This has been some really great price action here the last 4 days. So that's 4 consecutive days of higher closes in March corn. Today would be a fifth. If we could bust through this 450 level, would be very nice. The ending stocks projection for the United States went from 1.938 billion down to 1.738 billion. So a 200 million bushel cut to the ending stocks projection. That's a good deal. So USDA, the exports, this was the big piece of the demand base that was adjusted higher. USDA is now projecting the second largest U.S. export program on record, behind only the 2020-2021 marketing year. And that year was associated with a significant degree of Chinese buying, whereas we have not seen that this year. And this is all despite the fact that export sales are the third best of the last 10 years. We're actually not quite where we were in 21-22. So there's been this whole narrative out there that, hey, the export program and all these sales, they're all front loaded. Everybody wants to buy corn and get in front of a Trump presidency or tariffs. And USDA, I think, is kind of saying, no, this may very well continue. And as a matter of fact, you're going to have the second best U.S. corn export program on record. I totally agree with the change to ethanol. I think they could come up even higher in the future. Stocks to use ratio is the best way to gauge supply and demand. I know a lot of you guys just like to look at the carry out and say, oh, it's 2 billion, it's 1.6, it's 1.7, it's 1.8, whatever. This is the better way to gauge supply and demand. The ending stocks to use ratio projection is actually a little bit lower now compared to last year, which for me would signal that if this is reality, if USDA is correct in its export assumption and its ethanol assumption, it probably takes a trade below $4 on the board off the table. That probably ain't happening if we're going to be below last year with regard to stocks to use. Now, that's an if. USDA could be wrong and premature with that big upward revision to its export estimate. But you know what? We'll take it. We'll take the rally. This is a nice looking deal, and it's nice to report some good news every once in a while. I know everything's been negative for a long time. What about soybeans?
So USDA continues to project a burdensome soybean situation. The government left its current marketing year U.S. balance sheet totally unchanged yesterday. The Brazilian crop estimate was left unchanged at 169 million metric tons, while the Argentina production estimate was increased slightly to 52 million metric tons. The global supply and demand situation is projected to be the second most bearish on record, behind only the 2018-2019 marketing year.
USDA didn't do much on the soybean balance sheets. They raised Argentina by a little bit. I was even surprised by that. I figured they'd leave it alone. So this is the big deal. World soybean ending stocks to use ratio. Premium subs, you guys have ending stocks to use ratio charts that are updated for all three crops, domestic and global, in the email this morning if you want to look at them. But 32.7% stocks to use for the world would be the second highest on record, behind only 18-19. So this is bearish, and this has some price implications, not only for soybeans, but also for corn. I posted this on Twitter yesterday. I said, market 96 million corn acres, dude, referring to the corn soybean ratio. And I was not being serious because Twitter's not a serious place. This is not my serious estimate. But when you look at this, I absolutely think that we'll plant more corn acres in 2025 because soybean prices are so bad. Now, Mackenzie, we did a customer survey, a subscriber survey a few weeks ago, and we asked our subscribers, what do you plan to do with corn and soybean acres next year? And almost 30% of those who responded said that they'll plant more corn acres versus 2024. 64% said no change, and that's normal. Most people don't change rotation a whole lot. They stick with their normal type thing. Only 7% said more soybeans. Now, here's a question. Mackenzie, put your farmer hat on.
Oh, boy, here we go.
You're a farmer, and you have two crops that you can plant. You can plant corn or you can plant soybeans. Corn is more expensive to plant, but it pencils better. Soybeans are cheaper to plant, but they pencil much, much worse. Which one do you plant?
Do I have to go all in on one crop?
No, but I mean, if you're gonna shift anything around, like does the
Yeah.
better looking budget situation associated with corn, and it's significantly better,
Yes, I would definitely go more so with the better budget situation considering how things have been.
even though it's more expensive, and even though you might be a little bit tight on cash after the last couple of years.
Not fully. I would probably increase corn by 25%.
Okay, so yeah, I mean, that's the question right now is, corn pencils better. They both lose money for most farmers. Keep that. They both lose money. Neither of them are good, but corn loses less money, but it's more expensive to plant. So this is going to be a question that we wrestle with for a while here. And, acreage numbers are very difficult to predict. USDA had the corn acreage number for 2025 at just 92 million in their November projection. I think in their long-term projections, I think that's way too low. USDA will fully admit that their March numbers are no good and that they really don't get a feel for it until June. So this is going to be something that we continue to discuss for months and months and months.
So if you guys have not checked out our premium content, you need to do so. Joe, can you tell our viewers why Report Day is such a great day to be a subscriber?
Great. Every day is a great day to be a premium subscriber, but Report Day especially. I had the ending stocks numbers and the high level stuff blasted out via text, I think within 30 seconds of the report. And then I had my USDA snapshot, quick overview out within 10 minutes of the report. And in these videos, they're quick, like 3 or 4 minutes long. I just kind of run through the high level items. Is it bullish, bearish? What were the big changes? That's a good deal on report day. If you guys want to see the premium stuff, go to standardgrain.com. You can sign up this morning. It's a $50 per month subscription. You can cancel at any time. No other fee, no other obligation. Nobody tried to sell you anything else. You'll get our morning email every single business day at 5 a.m. Central Time. That email includes all of our headlines, a whole bunch of graphics, charts, all of my cash grain marketing recommendations. You will see links to our 6 most recent premium videos. Give that deal a shot today, guys. I'll forward you a copy of this morning's email.
China is ready to implement any necessary stimulus measures to counter the effects of U.S. trade tariffs. To boost growth, China will adopt a more relaxed monetary policy and proactive fiscal measures. The shift demonstrates China's readiness to incur greater levels of debt to tolerate an increasing debt to GDP ratio. The extent of China's policy will be determined by the timing and levels of new U.S. tariffs. The move comes amid deflationary pressures and weak consumer demand caused by a prolonged property crisis and limited social welfare. China's policy shift will focus on consumption and high-tech manufacturing. It will also prioritize managing risks over investing in traditional infrastructure and property.
One analyst said this: they've by and large made peace with the fact that the debt to GDP ratio is going to rise further, and added that it was no longer a binding constraint. It sounds just like the United States. I mean, all these countries around the world just continue to basically print money and stimulate their economies, and the debt to GDP ratios continue to rise, which is very, very bad. They're choosing the economy over their currencies, essentially. We've done that with the US dollar too, and there are some big long-term implications there. Another analyst said they are willing to do whatever it takes to achieve the GDP target, meaning that they could run the debt off the rails. They don't care. We don't care here in the United States either. As long as your GDP stays good and we're productive, doesn't matter that the currency suffers. So I guess this is not necessarily surprising.
President-elect Donald Trump's tariffs may not be as impactful as originally thought. According to leaders of Guggenheim Partners Investment Management and Franklin Templeton, the tariffs are more of a negotiating tactic. It's likely that the tariffs will be targeted rather than universal, and they won't be as severe as many people believe. Experts have criticized Trump's America First policy, arguing that his proposed tariffs might trigger a trade war. Overall, analysts anticipate Trump's policy plan will negatively impact the global economy. However, the effects of the plan will likely be delayed due to the slow pace of business in Washington, D.C.
This would make sense or jive with what's going on in the grain markets. People who have considered the prospects of a Trump presidency and the tariffs, a lot of people are really bearish the grain market, soybeans in particular. A lot of people believe soybeans should be trading below $9 on the board because of the stuff we mentioned with global supply and demand, but also because Trump, the tariff man's coming back into the White House. But at the same time, large money managers, when we talk about the funds, they have an agnostic position in the grain markets. They have a minimal net short position in the soybean market. They just don't seem overly concerned about that. So I guess that this article kind of does mix well with what's going on in our grain markets. And I know this is not grain market specific, but it kind of makes sense. And I guess it adds up.
The downward trend in inflation likely paused in November. Today's CPI report is anticipated to show an annual inflation rate of 2.7% last month, an increase of 0.1% from October. On a monthly basis, inflation is expected to have risen 0.3%. Traders are still predicting an 88% chance that the Fed will lower rates by a quarter percentage point at their meeting next week. The market is proposing only 2 rate cuts in 2025. Some economists worry that Trump's proposed tariffs could keep inflation high next year. That report will be released here this morning at 7:30 Central Time.
The Fed has officially stated that 2% is their target inflation number. Yet CPI has been running 2.5, 2.6 the last couple months. So we're not quite there. And the Fed does have to, look down the road, and they're trying to project what's going to happen months or even years from now. I don't know. Have they raised their target inflation? I mean, they're cutting rates when inflation's still 2.6, 2.7%. I don't really know. I think that a reinflation event is, I'm not going to say it's impossible. And that's something that could impact the commodity markets down the road. If you see like, a 1970s, early 1980s type deal, and you see kind of a yo-yo in the inflation numbers at some point here the next couple of years because of tariffs, because of deportations, whatever. I don't know if that's what's going to happen, but if it does, that would probably bode well for our commodity markets. It did the last time we had the big inflationary run up in 2022. What did cattle do yesterday?
Cattle futures had a tremendous day. Live cattle were 87 cents to $2.05 higher. Feeders were $1.42 to $2.25 higher. Box beef was mostly lower. Choice ended the day at $311.73. That was down $2.41. Select ended the day at $279.65. That was up 31 cents.
Outside markets, U.S. dollars up a little bit. Stocks are mixed. Bonds off just a little bit. Crude oil is up 65 cents in the January WTI at 69.24. Have a great day, guys. We'll talk to you on Thursday.